Two big concerns over the past months have been inflation, which has mainly been on the rise, and economic growth, which has been a bit shaky at times and caused some concerns in the market about whether the economic recovery is as strong as expected. So this has led to the bad S word being warned about, stagflation. And that's what I'll be explaining in this video, starting with the question, what is stagflation? In terms of basic economic theory, when an economy is growing, demand for goods and services will also be rising. This goes hand in hand with other factors as well, such as the employment situation. So as demand rises, more goods and services will be produced and more workers will be needed to produce them. This leads to an increase in wages and a decrease in unemployment. This in turn leads to more demand for products and services, which leads to higher prices and so on. Of course, when we're talking about prices for goods and services increasing, we're talking about inflation. So we can expect inflation to be rising when we're going through economic growth. On the other hand, if economic growth is declining, we can expect the opposite to be happening. Prices will be falling as there's less demand, workers will be laid off, wages will be declining. This leads to even less demand for goods and services, and prices will fall. Therefore, we'd normally expect inflation to rise when an economy is growing and to fall when an economy is declining. This is in basic economic theory. But in reality, we can also have a strange situation where inflation is rising, but economic growth is not. This is what's known as stagflation. To be specific, stagflation is a combination of two economic issues. The first is stagnation, which is when the economy goes through a period of low or negative economic growth. It's said to be in stagnation when GDP falls below 2% annually. And the second factor is persistent high inflation. This is considered to be high when it's above the central bank's target, which is typically 2% for most major central banks. So when both of these economic issues are at play at the same time, the economy is experiencing stagflation. I'm sure you can guess that stagflation isn't a good thing for the economy. It's something that policymakers would be desperately trying to avoid. Since low economic growth is not going to be a positive situation for workers, it means unemployment or wages that aren't rising, combined with inflation that is rising, it's going to make the cost of living very difficult to manage and give less purchasing power to consumers. This will be reflected in measures like consumer confidence, which would be in decline. Periods of high inflation can also lead to a wage price spiral, where workers demand higher wages to offset the rising prices. However, rising wages will also drive inflation higher as prices for goods and services also need to rise to cover the extra costs. Overall, this can be a miserable time in an economy and a pretty tricky one to be able to fix. Stagflation has happened before in a number of economies, with the most notable period being during the 1970s. And in fact, this was where the phrase stagflation came from in the first place, as it was thought that low growth and high inflation wasn't even possible at the same time before then. So part of the cause of stagflation during the 70s can be linked to cost push inflation. This is typically a temporary factor driving underlying inflation, such as a sudden rise in oil prices or other commodities. There were also other factors involved, such as workers demanding higher wages, which created the wage price spiral, where wage inflation almost hit 30% in the UK during 1975. So let's take a look at what actions policymakers can take. But before then, I just want to ask you to take action as well and just hit the like button to support the channel if you find this helpful or interesting. I really do appreciate it. As we've been hearing from central bankers a lot recently, monetary policy isn't really designed to solve issues on the supply side, any sort of supply side shocks. So that makes it difficult for central banks to try to fix the issue. On one hand, what central banks can do is to tighten their monetary policy. If they're doing something like quantitative easing, this can be an issue if it isn't leading to economic growth, as the extra liquidity in the economy will be leading to inflation. However, when they tighten monetary policy in a situation when the economy isn't experiencing growth, they run the risk of pushing the economy into a recession, as it would still reduce the total demand for goods and services in the economy, known as aggregate demand. On the other hand, central banks would also want to maintain maximum employment, and to achieve that, they may want to loosen monetary policy in an attempt to support economic growth, as that could increase aggregate demand. The big problem is that they can't do both actions at the same time, so there will need to be a trade-off between price stability or maximum employment, which is why they'd be keen to avoid getting into this situation in the first place, because they're in a catch-22. This is likely to be one of the reasons why many major central banks are holding off on tightening their policy too soon, since that could damage economic growth and harm the labour market. So instead, by keeping rates low and accepting some temporary cost-push inflation, central banks are basically saying that it's less of a risk than undermining economic growth. Now, one case that we've been seeing already is in the UK. We're currently seeing some minor stagflation, and if it does become more of a problem, then the government may need to take the lead in addressing the issue, since they can introduce policies that address the supply side. As I mentioned earlier, cost-push inflation is usually temporary, as we've been hearing from central banks quite a lot this year, so tolerating some higher inflation may be the price that we have to pay to maintain economic growth and maintain a strong labour market for now. So let me know in the comment section any other topics that you'd like us to cover in these explainer videos, and please do hit the like button if you found this one helpful or interesting, and I'll see you in the next video. Take care, guys.